Good afternoon or good evening, expats, wherever you may be located. We've got people dialing in from not only Australia, but also to Asia, Middle East, Europe and the UK. So welcome all. My name is Brett Evans and I'm the Managing Director of Atlas Wealth Management. And I have the distinct pleasure of running you through what's one of our most exciting times in the year, but I'm sure for you guys it's not. So to give you an idea, we'll probably be running for about 20 to 30 minutes talking about the key discussion points. And then we'll be opening the questions open to after that for any questions that may have. Just on a housekeeping issue, if you do have any questions, please use the questions box to ask those. Probably don't put your hand up through the seminar. As the questions come to you, just fill out the question on the question pane. And then what I'll do is after I've run through the 6 key points for the budget this year, then I'll go through and answer those questions. Just got to bring up on my screen and share my screen here with you guys. Just give me 2 seconds. Okay, can everyone see my screen there? Can I just get a couple of answers to say yes, please? Fantastic. Thanks, Paul. Thanks, Marilyn. Righto, guys, let's get on with what is an exciting time of year. I'm saying that firmly with tongue-in-cheek, but as we do say, these type of events do have an impact on your wallet. So we'll try to cover off on those key points and help you make the most informed decisions. Any financial webinar always starts with a disclaimer. There's a lot of jargon in there. Essentially what it's saying is that the information we're providing here is general in nature and do not construe it as personal advice. We encourage you to seek professional advice from either a licensed financial advisor and or an accountant. Who is Atlas Wealth Management? We're the leading provider of Australian expat financial advice and won a number of domestic and international awards for the work we've done. We work with clients in over 28 countries. I think it's a little bit more now, but we know it's definitely at least 28 anyway. And we have the pleasure of working with Australian expats in many different jurisdictions, but they all share the commonality of dealing with the Australian issues that we're going to talk about tonight. As the only firm in Australia and the world, for that matter, that specialises in Australian expats, we are the true global financial advisors to you guys. So point number one, what sort of budget was it? Well, we sort of call it a Goldilocks budget. You know, not too hot, not too cold, just right. And pretty much they've positioned this budget in the build-up to the election. They could have cut back spending. They could have brought a surplus into the 2018-2019 financial year, and they could have gone to an election saying that, you know, the budget is in surplus. However, they've obviously dangled a number of carrots, which the Harvey Normans of the world are going to enjoy over the coming 12, 18, 24 months when we run through those key points. Just as a bit of a heads up, the election is going to be called for either the 11th or the 18th of May for those who are registered as an overseas voter. The reason why it can't go past the 18th of May is if it does, then they can't hold both the House of Representatives and the Senate election at the same time. So in order to keep those two joined, they need to call it either on the 11th or the 18th of May. So obviously the first place that we always start is with respect to the personal income tax cuts. And essentially what we saw was an extension of what was announced in 2018. However, there's been a couple of minor amendments to what's going on. I'll run through those right now for you. So from July last year till June 2022, there's going to be an increase in the low and middle income tax offset from a maximum of $530 to $1,080 for those earning below $90,000 a year, and $2,160 for those dual income families. The reason I made mention before to Mr. Harvey and all the other retail stores is essentially what's going to happen is if you do earn below $90,000, when you do lodge your tax return, you'll actually get a cash allowance back from the ATO as part of your refund. So look, it's not a big amount. It's not like any sort of things we've seen in the past, like the first homeowners grant, the baby bonus and those sort of things. But what we do see out of this is the government's attempt to try and offset the rising cost of living and nothing like going into an election dangling a $1,000 carrot in front of all the voters' faces. What we're also going to start to see too is a change in the tax brackets, and we think this is a positive thing. So from 1 July, and before I go any further, this is all predicated on the fact that the coalition does get re-elected next month, and also too, these policies do get passed through Parliament. So just take that with, keep that in the back of your mind when we're talking about these future changes. So from 1 July 2022, the upper threshold for the 90% tax bracket will increase from $41,000 to $45,000. And then what we're going to see is in July 2024, the 32.5% marginal tax rate will be reduced back down to 30, and the 37% tax bracket will be abolished. And what we're going to see is what we call a mega bracket. So everyone who's on a wage from $45,000 up to $200,000 will essentially be on a 30% marginal tax rate. This works out to about 2 in 3 workers throughout the Australian workforce. So we sort of see the government moving towards a lot more cleaner marginal tax bracket management, and we think it's a positive because some of the key considerations that happen with workers, first of all, we see bracket creep. You know, you get that promotion, you get a pay increase that pushes you up into the next marginal tax bracket, and in actual fact it doesn't mean a lot for your take-home salary. So by doing this, what the government's trying to do is encourage people to work harder, work more, and by doing that, what we're going to see is their income's rising, but they're not going to change marginal tax rates as long as they stay below the 30%. As long as they stay below the $200,000 income threshold. So this is how the tax tables are going to look. So right here, this is what we're seeing right now, and then as you can see here, when we go up into 2022 to 24. Now we're starting to see the top marginal tax, the top bracket for the 19% tax threshold going from $37,000 up to $45,000. And then down here from 1 July onwards, we see a very simplified tax bracket going from 19% to 30% up to 45%. So just running through some of these issues, and obviously with those income issues, there has been any announced changes with respect to the non-resident marginal tax rate. So that's more going to affect people who plan on returning back to Australia to work over the next 5 years. So just be mindful of that. Obviously, when you're considering a number of issues, certainly you know what your take-home salary is going to be. Obviously, if you're coming from a country that has a low tax or a different tax structure to Australia, then obviously you're going to have to sort of rejig your calculations when it comes to your take-home salary. The next big issue we've got here is superannuation, which there's a number of changes announced which we think are very positive for Australian expats. The first one is the no work test that's been extended to age 66. Essentially what it means is in the past you've always been able to contribute to super when you're working in Australia or working overseas, and because you've been working. That's what we call the work test. The work test is a 40-hour working period in any 30-day period. Now what's happening is when we've got up to age 65 before, if you wanted to, age 64, anything beyond that, if you wanted to contribute to your super account, you had to meet this works test. And what it meant was a lot of people were having to go out and get some short-term employment or some sort of gainfully employed capacity to meet this work test in order to keep contributing to your to super fund. Now we're seeing that the works test has been extended up to age 67. So it virtually means everyone up to the age of 66 does not have to meet that works test. Obviously, if the legislation passes, that'll be effective from the 1st of July 2020. We often see more so our longer-term expats run into this problem of trying to get money into super when they do return after retiring back in Australia. And quite often the problem is usually they hang up the boots overseas, they come back to Australia, but then they have to go through the process of meeting a works test to keep contributing to their super as they repatriate their capital back into Australia. This is another good one as well, and we use this a lot of times for clients when they're repatriating back to Australia. Essentially what the bring forward rule is every year you're able to make a non-concessional, that's after tax contribution into your super, up to a rate of $100,000 per year. However, using the bring forward rule, what you can do, you can actually make 3 years worth of contributions in 1 year. So instead of contributing $100,000, you contribute $300,000, but then you can't do any contributions for the next 2 years. Now, using the bring forward rule, now it's been extended up until the age of 66. In the past, you could not use that past the age of 64. So once you hit 65, you could only put in $100,000 a year every year after that. Now that the bring forward rule has been extended up to age 66, we're able to see clients are able to, by using the 3-year rule, at age 66 make 3 years worth of non-concessional contributions, which virtually takes them up to age 69. And as I said, now we've got the non-concessional contribution cap reducing down every year. Previously it was $180,000. Now it's $100,000. Expats are finding it more and more difficult to try and get money into super, and this just buys us a bit more time, and we can obviously expedite the process. This is another good one too. Spousal contributions have been extended to the age of 74. Now, what we often see with both resident and non-resident clients is there is a mismatch in the super balances, and normally it's because one of the partners or spouses will raise the kids. If you move to a country and the spouse is on a family visa that doesn't enable them to work, quite often what we see is one partner's super will increase because they're able to keep contributing while the other one sort of falls by the wayside. With the spousal contributions, this is especially useful because now we have a $1.6 million super cap, and what that super cap relates to is you can have up until when you convert your super into an allocated pension, as long as the balance is below 1.6 million, then you do not pay any tax on any capital gains or income. By enabling us to contribute into super into a spouse's account past the age of 65 and 66, what it means is if, say for example, the husband is retired and the wife is not, then what we can do is, as the husband is in an allocated pension, we can pull money out of the husband's super account and make a non-concessional contributions obviously into the wife's account. So this is a great way that we can actually rebalance and pick that up. So just 1 second guys, my headset is about to go dead. I'm just going to plug it in here. Sorry, I've been running a few of these today and running out of batteries there. This is another one too, and this will affect Australian expats. There's a new package being brought in called Protecting Your Super. And essentially what it means is the bill's proposing to prohibit trustees from offering insurance on an opt-out basis for new members under the age of 25 who open an account on or after the 1st of October this year and with balances less than $6,000. Now, how this may affect Australian expats is one of the most often used strategies when you can't procure life or TPD insurance outside of super or overseas. We do look at your existing super account to see whether your current insurance inside of that account does cover you overseas. And what we can often do is reduce that super balance down to a minimum, and that account essentially becomes a funding vehicle to pay for your life insurance. Now, what they're talking about right now, and even though we use this for a lot of people, especially above the age of 25, is people below the age of 25, we're going to have to make sure that the balance we opt in to retain those insurances. And what I'll do on the next page is this is what happens with those who are over the age of 25. If your account is deemed inactive, and by inactive there is no contributions being received for a 16-month period, then what may happen is that super fund may deem your account inactive, and what they do is they then pass that to the ATO, and then the ATO is going to consolidate that with any other active accounts that you might have. So first of all, for those who do retain low balances to retain insurance, we're going to make sure that we continue to provide small contributions, and the numbers aren't out yet. We're not sure exactly what that number is. Obviously legislation hasn't been drafted yet, but what we're going to find out is making sure that we keep those small contributions going and topping that account up. For those Australian expats who do not have any insurance issues, and more so they've just lost track of where all their super funds are, then this is a great result, because as long as you've got one super fund that looks like it's active and it's being managed correctly, what will happen is if you've got 3 or 4 super accounts lying around, you've forgotten who they are, where they are, the account numbers and everything, what's going to happen is if after 16 months that that super fund doesn't see an activity from your account, they're going to automatically push that through and consolidate with your current active account. So that's a good result. It's always been a bit of a problem for us when we're trying to track down old dormant super accounts. If you've lost the paperwork, it's a bit of a needle in the haystack type approach. For those who've been following us for a while now, both on the blogs and the videos, you've probably seen us talk about key issues relating to the exchange of information. And that can relate to both the FATCA agreement between Australia and the United States and also the Common Reporting Standard, which is a global reporting framework between over 100 countries and territories. What this list means is from the 1st of January 2020, these countries are joining the list of exchange of information between Australia and that jurisdiction. So most people sort of freak out a little bit, say, oh my God, they're going to start passing information. A lot of countries are now anyway, so they're probably doing it without you realising it. And if you open up a bank account overseas, you probably notice that when they find out you're an Australian expat, they'll ask you for your Australian tax file number. The reason they do that is because every year they're going to pass that bank account details onto the ATO. The benefit, obviously, of these countries joining that list is at the moment, because there is no double taxation agreement or agreement in place between Australia and those countries, if you are investing in Australia and you receive income from what we call non-taxable real property, so shares, managed funds, ETFs, listed investment companies, those types of assets, and there's no franking credit attached, then you have 30% withholding tax automatically being deducted from that payment. By these countries joining the EOI list, what it means is that now reduces down to 15%. So if you are receiving income, you live in those countries receiving income from shares, managed funds, ETFs that don't have any attached franking credits, then that's a bit of good news for you. So your withholding tax rate is going to reduce from 30% down to 15%. Obviously, there's other strategies we use to negate that 15%, but that's a conversation for another day. Just late last month, the Australian government announced that they'd signed a double taxation agreement with Israel, which is good news for those expats living in Israel, and there's quite a few. And what it means is the DTA is in place to avoid the possibility of double taxation. It's going to recognise the sovereign nature of each of the countries, and essentially what happens is if you're earning income in Australia and Australian government taxes it, when you declare that to the Israeli tax authorities, they're going to recognise the taxing right of the ATO and then apply any applicable taxes above and beyond what you've already paid. So we do see a number of countries that have this problem, and they're slowly working through that list, and it's good to see that expats in Israel will now have that protection. Okay, and this is the big one that most people have been holding out for, and that's the main residence exemption. For those who are new to the topic, essentially in the 2017 federal budget, the federal government proposed the removal of the main residence exemption for non-residents. And what they didn't foresee, and it still blows me away that they didn't see this, is that by removing the main residence exemption, it essentially opened Australian expats up to paying tax all the way back to 1986. So what it meant was if you bought a house in Bondi for, call it $500,000 back in 1990, and you moved overseas in, call it 2019, and for whatever reason you sold that property while you're overseas, whether it was one day, a week, a month, or a year into being overseas, then essentially by the proposal, they were going to tax you at the non-resident marginal tax rate all the way back to the date of acquisition. We were heavily involved in lobbying Canberra, and the only real peace of mind we got was when the Assistant Treasurer was at a Tax Institute conference a couple of weeks ago, and he insinuated, didn't say it, but he insinuated that they weren't going to proceed. Our concerns were we did not see a formal announcement by Canberra that they're going to drop this one, and we were concerned that a Mark II version was going to appear in last night's budget. I'm pleased to say it hasn't happened, but the fact that there has not been a formal denouncement of that legislation leads me to believe that it's probably still sitting on the shelf, and we may see it come to fruition in the coming years. There's a lot of issues that they did not foresee with respect to obviously unintended consequences, like I explained before, with the capital gains tax going back as far as it did, but also it had an estate planning issue, it had a family law issue. The deeper we dug, the more issues that everyone found. So glad to say that essentially today was the last day it could have got passed through the Senate. It wasn't passed. It wasn't even on the bill of consideration. So it's gone for now, but something tells me it's not gone for good. So we'll keep everyone posted on those questions there. Okay, so let's just quickly run through some of the questions. Okay, so question from Marilyn. This doesn't apply okay, so this doesn't apply though to non-residents for tax purposes, right? So I think, are you referring to the income tax rates, Marilyn? If you are, that's correct. So there's been no change in the tax rates for non-residents. I don't have one. Okay, so then the other question was, I have one super account, I don't contribute to it, what would happen to it? It's a good question, and the devil's always in the detail, Marilyn, when it comes to what's obviously announced with respect to the legislation. Normally what they have to do is apply some sort of guardrails in terms of, key dollar amounts. We've seen in the past when the government tried to take over inactive bank accounts. So we went through and worked out, okay, what stipulates as a contribution or an activity, and they normally have to outline those details. So at the moment, we're sort of saying to clients, if you throw a couple $100 in, well, that's a contribution. We're not sure that's enough yet, but don't be too panicked yet. Obviously, when we start to see the details coming out of Canberra, at that point we are going to start putting out some blog posts and obviously videos that go into more detail. Okay, while going through some other questions there, a bit of other housekeeping, and this is what I was saying before. We encourage you to follow us on these respective social media channels. We've also got a YouTube channel and a podcast now, so we need to update this slide. Social media accounts are fantastic for us because it enables us to communicate with Australian expats very quickly. As long as you've got any sort of internet connectivity and obviously a social media account, then we're able to disseminate information very quickly. And that's one of the biggest things we try and do, and we sort of champion the cause for ourselves that we want to get out there and make sure everyone's fully informed and aware of all these changes, because we know that Canberra does a very poor job in communicating this with expats. We're not sure whether they rely on osmosis or ESP or how you guys are meant to understand or learn about these issues, but we sort of take it upon ourselves to educate and make sure the word gets out there anyway. Okay, I got a question here from Tina. Hi Brett, I'm on a work permit in Canada and not sure if I'm a non-resident for the 2018 tax year. Okay, Tina. Probably the key issue you've got to ask yourself, when did you move to Canada? And then the second part of it is, have you done any final lodgements with the ATO? And this is good practice. A lot of people, when they are going to get on the plane, they're looking at where they're going to live, where the kids are going to go to school, what the social life is like, what sort of sporting activities they can do. But they don't do the sort of housekeeping issues before they leave. The problem with that is the ATO doesn't know you've left unless you tell them. So good practice is obviously to engage an accountant and do your final lodgement. And essentially what they do is they'll notify that Tina left on this date, therefore this is going to be her tax return for the 2018-2019 financial year. When it comes to qualifying as a non-resident, there are obviously a lot of considerations there. There's the resides test, the domicile test, the 183-day test, and also the Commonwealth Super test. So it comes down to when you move over there and you're on a work permit. So obviously you need to go through and satisfy yourself. There's actually a page we put on our website, which I'll put up shortly, and essentially that goes through how to qualify as a non-resident for tax purposes. And this is still a very grey area as far as the ATO is concerned. We saw a very big case just recently called the Harding case, and long story short, if your situation is opaque and that you've got family members or partners straddling different jurisdictions, it does make it more complicated. Obviously, Tina, in your case, definitely have a chat to an accountant and determine what your status is, and obviously get that final lodgement as well. You do not need to wait for the tax year to start or the tax season to start to make that lodgement. You can make that lodgement any time through any sort of accountant. Okay, so running through some more questions here. Okay, question we've got here is with respect to Labor's proposed changes, and there's been a few of these flying around, and probably how they're going to affect expats. Well, yeah, they certainly will. The first key one is obviously the change to negative gearing. So essentially what's going to happen is negative gearing will, and this is obviously on the proviso that Labor gets in at next month's election. If Labor does get in, they want to remove negative gearing as of the 1st of January 2020. And what that means is if you buy a second-hand house as opposed to a new build, then you will not be able to accrue tax credits. It's been one of the most common strategies we've had with expats over the last 10, 20 years, where you can accrue tax credits back in Australia so that when you do return to the country and you start earning Australian sourced income again, in that case you can then use the tax credits to offset against your income. If Labor does get in, and if this proposal does get through, essentially you would no longer be able to accrue those tax credits. The second problem we've got with the proposed Labor changes is obviously the reduction in the capital gains tax discount from 50% down to 25%. So if you do own a investment property, then and you held it for longer than 12 months, in the past you would have got a 50% discount on the capital gains tax bill. Now they're going to reduce it down to 25%. So essentially you'll be up for 75% of the tax bill. So that is going to certainly affect Australian expats as well. Franking credits, look, that's going to probably more so affect those who are who are retiring overseas or looking to retire overseas or looking to retire back in Australia. And essentially what's been happening is in the past, if you had a self-managed super fund and you had franking credits attaching to those dividends, then when you lodge your super return, the audited return every year, you essentially got a payment back of those franking credits. There are sort of ways around this, and it's not the end of the world for us, but it's certainly going to throw a cat amongst the pigeons with a lot of those people with self-managed super funds. They're the main target. Obviously, if you are resident overseas with a self-managed super fund, that's not your only problem, because the other problems you've got to contend with are both the central management and control and the active member test as well too. So just be careful with those sort of things, because otherwise it does get quite confusing at times. And certainly if we have a non-complying self-managed super fund, then you can lose up to half your balance if it's deemed a non-complying fund. And that's probably the key things that we see out of Labor's proposed changes. A lot of other little bits and pieces certainly are changing in the tax brackets, but from our point of view, not being political at all, but certainly the Liberal Party focus on expats is a lot favourable than the Labor Party, because obviously from the franking credits and obviously from the CGT discount and obviously from the negative gearing aspect, a lot of expats do have property and they do rely on those accrued tax losses when they come back to the country to make it worthwhile. If you are dipping your hand in your pocket and topping up the mortgage or topping up the expenses, you want to get something back from that, and if you don't get anything back from that, then it's not a very good investment at the end of the day. Okay, more questions coming through here. Okay, another super question, and that's from Terry. I'll just go through here. So Terry's asking, what's the best way to manage your super as an expat? Well, look, it really depends in which country you're in. Any other country apart from the United States, the best way to manage your super is taking involvement in it. You know, we see so many clients who really, there's a fair bit of apathy towards super, and then once we go through and review it, make recommendations, make changes, and jazz it up, I guess you could say, it's amazing how the engagement levels increase, but also too, suddenly you're now looking at returns, you're making sure that your fees are commensurate with what you're expecting to receive. So super's great from an expat's point of view because it's agnostic. It doesn't matter whether you're a resident or non-resident, the tax rates and the benefits are still there. This is on the caveat, obviously, you know, excluding self-managed super for the previous reasons. But if you are in the United States, then that's another issue altogether. You know, we do have a number of issues that we deal with clients in the US. Essentially, the IRS does not treat Australian super accounts as a foreign pension. It treats it as a trust, either an employee benefits trust or a foreign grantor trust. And all depending on how your super is managed in Australia will determine whether the IRS actually taxes you, believe it or not, in the US. So, yeah, we'll probably be holding some more seminars and webinars later through this year to try and highlight the issues there and provide a bit more clarity. Okay, got a next question here from Glenn. I recently received a letter from my Australian super fund stating that my account may exceed 25k in contributions for the financial 19 year. These are all employer contributions and will pass 25k before 30th of June 2019. Anything extra to be aware of with this circumstance as an expat? Yeah, look, good question, Glenn. And we're finding more and more people are getting caught by this, and the reason being is that cap's been coming down. So 25,000 is not very high in terms of employer contributions and any other things that you might be contributing yourself. Look, what you're going to need to do is have a chat to an accountant and or financial planner about that, because you're going to have to do quite a fair bit of paperwork in the lead up to 30 June to try and rectify that issue. Sometimes if you are quick enough, you can fix it, but if not, then there's the very real chance that either extra tax will be applied on that contribution, or that money will have to be refunded and reorganised. So definitely have a chat to someone about that, because yeah, that can become quite an issue, and you know, people are sort of relying on old numbers sometimes, and that's the most common reason why we see that 25 cap being breached. Okay, another question here from Barry. Okay, he's just talking about some of the key issues with respect to, sorry, my screens are scrolling here, just give me a sec. Okay, that's better. Just in respect to non-resident marginal tax rates. So Barry, there's no tax-free threshold when it comes to the non-resident marginal tax rate. The non-resident marginal tax rate kicks in at 32.5 cents in the first dollar. So if you make $1, and this is predicated on how that income is sourced, but if it's sourced through Australian revenue or investment property, anything that's classified as a taxable Australian property, then you will pay 32.5 cents straight away to the ATO on that dollar of earnings. So it's it's quite steep, and you know, I guess Canberra's been unapologetic in charging expats that. They think they're entitled to that. So we've seen a lot of changes with respect to how people earn their income in Australia and the different sources to generate wealth through that. Okay, another question here. I received rental income from my Sydney property. How to report it in my 2018 tax year? That's from Tina again. Tina, when you do your final lodgement with your accountant to the ATO, obviously you're going to have to declare that as well. So what happens is, once you become a non-resident, then any revenue from taxable Australian property, so apartment, house, farm, mining lease, all those types of any asset you can kick, if you earn an income off that, then you're going to have to lodge a tax return in Australia every year to declare that. And the reason being is, with shares, managed funds and ETFs, they're taxed at source. And what that means is, before the share registry passes that income to you, they see what country you're in and therefore can apply the applicable non-resident withholding tax. Because in your case, you've got a investment property, the tenant's paying you the money, so then you have to turn around and declare that money to the ATO. Now, most people do not run a positive cash flow investment property, so very rarely do we see tax being owed to the ATO. But for those people who bought a while ago, not recently, who do have low loans, and obviously with rents increasing, we are starting to see those the balances change, and people who were previously negatively geared are now positively geared. And if you're positively geared, then you will be paying 32.5 cents in the first dollar. Okay. Is there any other questions there, guys? Okay, if you're shy or you forget, actually want to hear from Paul. As an AU tax non-res, do you know if I charge AU companies B2B to my business, overseas business, I'm not up for tax in Australia? Look, that's a good question, Paul. Essentially, it relates to how your business is structured. Are you established or indoctrinated in a particular country? Are you setting up a company that's registered in that country? Are you invoicing from that company? There's a lot of moving parts there. Look, without referring to your specific situation, generally speaking, no. You will have to obviously provide a tax invoice for that company to claim obviously back. But as you're providing services overseas to Australia, therefore, more often than not, you're not seeing any tax that you have to declare. The fact that you're an Australian resident sometimes is by the by. You do want to make sure that your I's are dotted and T's are crossed, because the ATO would love any chance possible to sort of try and grab onto that money. But just think of it like if you bought anything online. I'm sitting in Australia. I bought something online in the US from a mum and dad business. They're not going to declare that income to the ATO because they're not domiciled in Australia. Their business is not domiciled in Australia. So that's probably the simplest way to explain it without getting too complicated. There are other issues regarding transfer pricing, those sort of things. But look, I'd definitely have a chat to your accountant on that one there. Okay, Sharad's got a question here. What are the best options for investments in Australia for expats? Residential, commercial, shares, or ETFs. Look, I think there's two things here, Sharad. I hope I'm saying your name correctly. The first one is we always say capital appreciation is the most important part. It's pointless getting a yield if your capital is going down. So what you want to do is look at the different asset classes and see the upside potential versus the downside risk. Once you've done that and identified those areas, obviously property right now is on the nose, so we're not seeing a lot of demand from clients buying property. And if anything, we're actually seeing people selling property into this fall. Then you look at, so obviously with property, you don't get any, you don't get the 50% capital gains discount. You have to pay tax on any positive income at 32.5 cents on the dollar. So there's a taxable issue there. There's also a high income tax. With respect to the shares and ETFs, we see those as a very beneficial tool for expats. And the reason being is shares, managed funds, ETFs, and listed investment companies are classified as non-taxable Australian property. What that means is you do not accrue capital gains tax with the ATO on those investments. If you were to buy BHP and ANZ shares and you put $10,000 into each, and each share grew up to $15,000 and you sold that while as a non-resident, then under those rules, you are not liable to pay capital gains tax to the ATO. When it comes to the income from those shares, both of those shares are what we call fully franked. And to give a very simple explanation of what franking is, essentially what it means is, let's say ANZ made a profit of $1 billion. So what they'll do is they'll cut a check to the ATO for $300 million, and then they'll have $700 million left over to pass on to shareholders. Now, when they pass that dividend on to shareholders, you can't really tax it again because it's already had 30% tax paid on it. by ANZ when they pay the ATO. So you get what's called a franking credit, which is the 30% tax credit. The benefit for expats is, all depending on what country you're in, if you have a DTA or don't have a DTA, then 15 or 30% marginal tax rate is withdrawn from that dividend. But don't forget, you've also got that 30% franking credit attaching to that dividend. So if you do reside in a country that has a DTA, like Singapore, for example, then there's a 15% non-resident withholding tax that comes out of your dividend, but they won't actually deduct that because you have a 30% tax credit which offsets it. Okay, question here from Andrew. Earlier you mentioned that super is good because it's agnostic. If we are non-residents for tax purposes, is there really any benefit to using super rather than investing through shares, ETFs, etc.? Should non-residents avoid super and put their resources elsewhere? A great question, thanks Andrew, and this one's a horses for courses type answer. We've got clients who are 30 years old who put a lot into super. We've got clients who are 55 years old who put nothing into super. So essentially what it does is, some people like liquidity, and obviously if you set up an investment account, take into account trading terms, you'll get your money back in 5 days. Super's like the mafia, once they're never out, you have to wait for the preservation age. If you're the sort of person that likes the idea of socking your money away and short of being killed, you can't get access to that money, then super does work for you. We can use franking credits inside of super to offset the income tax rate of 15% inside super. So you can reduce the tax inside super down to an equivalent level of shares for a non-resident. Obviously with the capital gains tax, the capital gains tax, the way that works is for any assets held longer than 12 months, you pay 10% capital gains tax. So for some people, they see that as a trade-off, as a forced savings. You can't use the money on a holiday. You can't draw it out of an ATM on a Friday night. So it really is a horses for courses. Some people take a strategy of using both. So what we'll do is we'll work out a number they want to hit at a certain age, and then say, rightio, if you do it through super, this is how much you have to do. If you do it, in your own name as an investment, this is what you have to do. And it really comes, we talk to clients about, it's like walking onto a car yard. Do you want a 2-door? Do you want a 4-door, sunroof, red, blue, pink? It really comes back down to your own particular circumstances. But the good news is you have that choice of both. Okay, just a question here from Glenn. I wanted to clarify that I'm correct in stating that any share stocks that are purchased after date of leaving Australia and sold prior to date of returning to Australia accrue no capital gains tax. That's exactly right, Glenn. You raise a good point, because it's something that we've been seeing a lot of clients being caught out recently, and this is what's called deemed disposal. So if you own shares as a resident, let's say for example you've got Telstra, CBA, ANZ, BHP and the lot. When you go to leave the country, you can do what's called deemed disposal. So what that means is, on paper, you are deemed to have sold those shares and you pay the applicable capital gains tax based on any growth that you've accrued in that time. Then when you go overseas, still holding the same shares, you do not continue to accrue capital gains tax beyond that period. If you do not do that, and you do not do deemed disposal, then even if you hold those shares overseas as a non-resident, you still continue to accrue capital gains tax at the marginal tax rate. Glenn, in your case, if you are in Singapore, say for example you moved to Singapore on the 1st of January this year, and then you bought shares on the 1st of February this year, then you do not accrue capital gains tax with the ATO. Obviously, if you did sell those shares, you would have a requirement to disclose that to the Singapore tax authorities from a capital gains point of view, but from the Australian tax point of view, there is no applicable capital gains tax on those shares. We often hear clients get a little bit confused too when they do come back to Australia. They think they have to actually sell those shares before they move back in, but you don't. Essentially what you do is you take the date that you became a resident, and then you accrue capital gains tax from that date onwards. So you don't have to actually turn over those shares if you don't want to. It's just obviously from a paperwork point of view, you have to declare which part is tax-free and which part is non-tax-free. Okay. Is there any other questions there, guys? Okay, another question from Tina. I receive employee shares from my Australian ex-employer. How to report it in my tax return? Oh, that's a good one. Look, Tina, it depends on a lot of things, how those shares were gifted to you, either as a bonus, as an RSU. Really, it comes down to where you were at the time of receiving those shares, were you a resident, non-resident, you know, what the applicable earning date is for those shares. So when you do have a chat to your accountant about obviously lodging that that return, have a chat about that, because it can be quite complicated, or depending on how those shares were given to you. If they were options, employee options, then that's different with the vesting period. So certainly have a chat to an accountant, because everyone's situation is very difficult. Okay, Karen. Oh, good to see you there, Karen. Thanks for joining. Thanks, Brett. Very informative. Fantastic. Righto, guys. Well, it's 10:15 here in Australia, so unless we've got any other questions, I'll probably wrap it up there. If you do have questions or a bit shy, or you think of something later, then by all means, please do email us. Obviously, you'll receive an email after this seminar with a copy of the recording. Feel free to reply to that, ask any questions. Obviously, we can only answer general questions. We can't answer personal questions unless we do go through the process of providing personal advice. So if that's everything, guys, looks like it is. I'll bid everyone a good afternoon and a good evening, and we'll see you on the next webinar. Take care.